Welcome to the deep dive. Today we're unpacking a topic that's quietly becoming one of the biggest economic stories out there. This massive wave of wealth being inherited.
Right, and the maybe surprising challenge of actually making that money last.
Exactly. It's a mix of finance, psychology, and, well, a bit of history repeating itself, isn't it?
It really is.
Yeah.
We've been digging into a really insightful piece from The Economist on this. The title is pretty direct, How to Invest Your Enormous Inheritance.
Okay, so our goal here is to kind of cut through the complexity, pull out the essential insights from that article for you. We want to understand the sheer scale of this wealth transfer first.
Yeah, and learn from past mistakes. There's a really interesting historical angle.
And then figure out the core strategies the article highlights for investing, and maybe even more importantly, for spending that inherited wealth so it doesn't just, disappear.
Right, so it actually endures, maybe even grows.
Think of this as your shortcut to understanding what feels like a pretty world-changing financial shift.
So let's start with the scale because it's truly eye-opening. The article highlights that in 2025 alone, people in the rich world are said to inherit something like $6 trillion.
$6 trillion. Wow. That's not just a big number. The article points out it's roughly 10% of the GDP of those countries.
And what's really significant is how sharply this share has climbed. I mean, the portion of national output from bequests, it's doubled in France since the 60s.
Doubled.
Yeah, tripled in Germany since the 70s, and it's hitting levels like 20% of GDP in Italy now. This isn't a trickle. It's a flood.
The article notes this huge scale sparks two very different reactions, sort of predictably. On one side, there's this broader societal worry, right, about an emerging inheritocracy.
Right, concerns that maybe inheriting wealth might dull the incentive to work or widen inequality even more.
Or even distort things like marriage markets, the article mentions. We're just reporting what the source says here, of course.
Absolutely. Those are the big societal questions. But then for the person actually receiving the money, the reaction's likely quite different.
Yeah, probably a mix of, personal joy, maybe relief, and then this immediate practical question. Okay, what on earth do I do with this?
Exactly. And while for many people, an inheritance might mean, say, the value of a house or a nice little nest egg.
Which is still significant.
Absolutely significant.
Yeah.
But the article makes it clear a growing number are inheriting truly staggering sums. UBS reported 53 people became billionaires just through inheritance in 2023.
53 new billionaires from inheritance alone.
And many others received hundreds of millions. But it's not only the mega wealthy.
Okay.
The article mentions that in Britain, for instance, a quarter of people aged 35 to 45 are expected to inherit over 280,000 pounds.
That's about 380,000 US dollars.
Yeah, for someone in that age group, that amount could be utterly transformative. It could represent, decades of saving, all arriving at once.
So you've got this unprecedented amount of wealth changing hands. But the article then immediately steers us towards a really critical history lesson, a cautionary tale, really.
Yes. From America's first Gilded Age, this is where wealth managers Victor Hagani and James White come in through their book, The Missing Billionaires.
Right. They looked back at the roughly 4,000 millionaires in America back in 1900.
And they ran this fascinating thought experiment. They said, okay, imagine maybe a quarter of those, the richer ones, had $5 million or more back then.
Which the article calculates is worth about $3.8 million today, just in terms of buying power.
Right. And let's assume they did something simple.
Yeah.
Invested in the U.S. stock market, had, normal-sized families, pay their taxes.
And here's a key bit. They spent just a modest 2% of their capital each year. Seems quite restrained.
Very restrained. So based purely on investment returns, average family growth, taxes, you'd theoretically expect nearly 16,000 old money billionaires descended from that original group to be around today.
16,000. Okay, but here's where it gets really interesting and frankly a bit shocking. The reality. It's incredibly hard, almost impossible, to find even one family whose fortune today traces directly back, continuously and significantly, to those Gilded Age millionaires in that specific way.
They are, quite literally, the missing billionaires the book talks about.
So where did all that potential wealth go?
Well, the article emphasizes the main reason wasn't things like inflation or wars, which you might guess first. The main culprit, according to their analysis, was simply poor investment and spending decisions.
Oh, wow. That single point is so powerful, isn't it? It just perfectly sets up the core dilemma for today's inheritors. You might get this incredible opportunity, this potential for dynastic wealth, But history is basically screaming a warning. It's incredibly easy to mess it up.
Right. The fundamental question becomes, how do you avoid becoming one of those missing billionaires yourself? How do you make this wealth last, ideally forever, while still, being able to enjoy your life?
So let's get into the solutions the article discusses. What's encouraging, it suggests, is that the investment part, well, it isn't necessarily the hardest piece of the puzzle.
Yeah, which might sound intimidating to many people, but the article suggests you don't need some kind of magical, perfect strategy.
Right. It suggests that even relatively straightforward approaches can yield pretty spectacular long-term results, like those hypothetical Gilded Age folks just sticking to stocks would have done very well.
But to do even better, to optimize, the article gets into this idea of the ideal portfolio split, between riskier assets like stocks and safer things like inflation-protected bonds.
And it introduces a concept called the Merton share as a simple way to think about this. Can you break that down? What is the Merton share, basically?
Think of it as a kind of rule of thumb, a mathematical way to figure out roughly how much risk you should take. It's based mainly on what returns you expect and how much the value is likely to bounce around the volatility.
Okay, so balancing the potential upside with those gut-wrenching drops.
Exactly. Higher expected returns might suggest taking more risk, but higher volatility suggests maybe pulling back a bit. The Merton share tries to find that sweet spot.
So Hagani and White actually compared this more balanced Merton share strategy to the simple all-stock approach, looking back since 1900. What did that show?
The results are pretty stark, actually. The Merton share strategy, this more balanced approach, delivered a 10% annualized real return.
Okay, annualized real return, quick reminder. What does that mean for the listener?
It means the average return you get each year after you account for inflation. So it's the real increase in your purchasing power smoothed out over that whole long period.
And 10% is. That's very strong.
Incredibly strong, yeah. Now, compare that to the all-stock strategy over the same period. That delivered 6.6% annualized real return.
So quite a bit lower.
Significantly lower return. And here's another crucial point. The Merton share strategy was also 40% less volatile.
So higher returns and a smoother ride along the way, less dramatic ups and downs.
That's the finding. It really does seem like a win-win in that historical simulation.
So the conclusion is?
The conclusion is compelling. Following this more structured, balanced investment approach, like the Merton share suggests, would likely have resulted in vastly more old money billionaires today.
Okay, so while maybe not perfectly simple, the principles for investing inherited wealth wisely seem reasonably clear, or at least clearer.
That's the gist of it, yes. The article suggests that part is manageable.
Okay, so that's the cheery news, as the article frames it. Now for the worse news.
Right.
It argues that deciding how much you can actually spend from your inheritance is the much, much harder problem.
Which feels counterintuitive, doesn't it? You've got more money, surely spending decisions get easier.
You'd think so. But the article explains why these common, seemingly sensible rules, like, say, drawing down a fixed percentage of the initial value each year, are just fundamentally flawed.
Yeah, it says these rules aren't even really sound for typical retirement planning, let alone trying to make wealth last forever.
Give us the example the article uses. It really hammers this point home.
Okay, so imagine you started back in the year 2000. Not the best timing, market-wise.
Right, the dot-com bust was just starting.
Exactly.
Yeah.
And you had a classic portfolio, maybe 60% stocks, 40% bonds, and you decided, okay, I'm going to spend an amount equal to 5% of my initial portfolio value every single year, no matter what.
Okay, 5% of the starting amount, fixed dollar value each year.
Fixed dollar value. Even though that portfolio itself actually managed a decent return over the whole period, about 5.25% annualized.
Which is higher than the 5% withdrawal rate.
It is. But because you kept taking out that large fixed dollar amount based on the original high value, you absolutely hammered the portfolio during the market downturns in the early 2000s and again in 2008.
You were selling low, essentially, to meet the spending target.
Precisely. You depleted too much capital when the portfolio value was down. You were drawing down on a shrinking base, and it simply couldn't recover. The simulation showed you would have run out of money completely by 2019.
Wow. Despite the average return being higher than the withdrawal rate, that's sobering.
It really is. So sticking to a fixed percentage of the start value, even 5%, can literally be a path to ruin.
And the article says even lower rates are risky.
Yeah. It notes that even a more conservative fixed rate, like 4% of the initial value, often called the 4% rule in retirement planning, still carries a pretty significant risk of ruin. Simulations show it fails, meaning you run out of money, about a third of the time within 3 decades.
A 1 in 3 chance of failure within 30 years is not great if your goal is forever.
Not at all. If the goal is perpetual wealth, that kind of risk is unacceptable.
Okay, so the fixed percentage of the initial value is clearly the wrong way to go. What's the alternative? What's the optimal way to spend?
The article's solution, based on financial theory, is that the optimal amount you spend each year must be a percentage of the portfolio's value at that specific moment in time.
Ah, so it's a percentage of the current value, not the starting value.
Exactly. This is what they call the spending ratio. So if the portfolio value drops because the market had a bad year, the actual dollar amount you spend that year automatically drops too.
And conversely, if the market booms, you could spend a bit more that year.
Correct. That's the key benefit. This flexibility allows the portfolio to recover after a downturn because you're not forced to keep taking out that large fixed amount from a depleted capital base.
So your spending needs to fluctuate year to year if you want the portfolio to have the best chance to generate that necessary long-term growth.
That's the core idea. Your spending adapts to the market reality.
The article uses university endowments as an analogy here, which seems quite helpful.
Yes, it's a good comparison. Endowments generally operate this way. They don't spend a fixed dollar amount that was set decades ago.
Right.
They typically spend a percentage of the fund's current market value each year. Often they aim to spend roughly what the fund is expected to return on average over the long run.
And the goal there is to keep the fund's real value, its purchasing power, and therefore its annual spending power, roughly constant over time. Preservation is key.
Exactly, preserving the capital indefinitely.
Okay, that makes sense for preservation. But the article points out that just keeping the real value constant, just preserving it is, and I quote, hardly enough to start a dynasty.
Right. If your ambition goes beyond just making the money last forever, if you actually want it to grow substantially for future generations,
To build that dynasty.
then you absolutely must spend less than the returns your investments are expected to generate. You need to leave some fuel in the tank to let the capital compound and grow over time.
And this is where those incredibly difficult trade-offs really bite, isn't it?
It really is, because you have the immediate benefit, or what economists call utility, from spending money today.
Let's just clarify that term, utility. It just means
Think of utility simply as the personal satisfaction, the happiness, the benefit you get from something, in this case, spending money.
got it. And the article points out that the utility from spending tends to have diminishing returns.
Right. You know, the 10th sports car probably doesn't bring as much extra happiness as the first one.
Okay. But spending more today, getting that immediate utility, directly conflicts with that long-term dynasty goal.
Directly. Every dollar you spend today is a dollar that can't be invested, can't compound for the future.
Yeah.
And if your investments have high expected returns, spending today means you're potentially giving up significant future purchasing power for your descendants.
And compounding that difficulty is the fact that those returns are just expected. They're not guaranteed. They're inherently uncertain.
Absolutely uncertain. And then you layer on top of all this the very human trait of time preference.
Time preference.
Basically, we tend to prefer having something good now rather than waiting for something potentially better later. It's natural to value immediate gratification.
So balancing that immediate desire against the potential for much greater future security and power, maybe for people you haven't even met yet, that's the core challenge. It's psychological as much as mathematical.
It really is. The article mentions you can use complex mathematical models and simulations to try and figure out this optimal balance.
Yeah.
But it notes they're really hard to get right, and they're incredibly sensitive to the assumptions you feed into them about future returns, volatility, your own preferences.
Which makes a strong case, as the article subtly suggests, that maybe one of the best ways to spend a small portion of that inheritance is on getting excellent tailored financial advice.
Exactly. Because this is a really sophisticated optimization problem with huge human factors wrapped up in it.
So, okay, after navigating all this complexity, the history, the investing, the spending dilemmas, what are the core, straightforward lessons that anyone, regardless of the exact size of their potential inheritance, can take away from this?
The article does a good job of distilling these down. First, higher expected investment returns do allow for higher potential spending, but not proportionally.
Meaning?
Meaning, if your expected return doubles, you can't necessarily double your safe spending rate. The gap between your returns and what you can safely spend actually gets wider as expected returns go up. because there's more benefit from letting that higher potential growth compound.
Okay, that's interesting. What's second?
Second, the higher the volatility of your investments, the more wildly their value swings up and down, the lower your sustainable spending needs to be. Volatility basically acts as a drag on how much you can safely take out each year.
Makes sense. More bumps in the road mean you need a bigger safety margin.
Third, if you really dislike the idea of your annual spending fluctuating, if you strongly prefer stability, well, then you have to accept less investment risk.
Which means holding fewer stocks, more bonds, probably.
Probably. And that, in turn, likely lowers your overall long-term returns and therefore your total spending capacity over the long haul. There's a direct trade-off between spending stability and potential long-term wealth growth.
Okay. And fourth,
the less you absolutely need to spend each year as a bare minimum, the more flexibility you have. If your essential needs are covered by other income, for instance.
then you can tolerate more ups and downs in the inheritance portfolio.
Exactly. This allows you to potentially take on more investment risk, maybe hold more stocks, which could lead to higher average returns, and ultimately allow for higher total spending over that very long time horizon.
Got it. So those are the key principles. But if there's one single most important takeaway from this whole deep dive, according to the article, what is it?
It's this. Making an inheritance truly last forever, and especially if you hope for it to grow, requires spending far less than its expected annual investment return.
Far less. Those numbers you mentioned earlier were pretty stark. Can you give us those again?
Yeah, the article's analysis, using what seemed like reasonable assumptions about markets and risk tolerance, suggested that a near-optimal portfolio might have an expected annualized real return of around 4.1%.
Okay, expect to make about 4% after inflation each year, on average.
Right. But the optimal pre-tax spending ratio from that same portfolio, it was only about 2.4% per year.
Wow. So you expect to make 4.1%, but you should only plan to spend 2.4%. That's barely more than half the expected return.
That's the difficult reality the maths points to if permanence and growth are your primary goals. You need that buffer for volatility, for uncertainty, and for the capital base to actually increase over time.
And the article throws in one final complicating factor, too.
Yeah, just to make it even harder, this 2.4% spending target doesn't even account for how your family tree might grow.
Ah, right. More descendants over time.
Exactly. As generations pass, that wealth often gets divided among more and more people, which naturally cuts down the size of future individual inheritances, even if the total pot is growing.
It really all circles back to that powerful quote the article includes from Victor Hagani.
Yeah, it's worth repeating.
Yeah.
People often want to know how much they need to have to give each member of their family's next few generations a modest income. The answer is a lot more than most anyone thinks.
It truly underscores that what might feel like an absolutely immense sum today, enough to support a luxurious lifestyle forever,
might in reality require incredible discipline and quite modest spending relative to the capital if the goal is to make it last for multiple generations, let alone grow significantly.
So let's wrap up this deep dive. The key takeaways seem to be the scale of wealth being passed down is huge, unprecedented, and still growing. But just getting it is only the first step.
Right. History, particularly those missing billionaires from the Gilded Age, serves as a stark warning. Inherited wealth can vanish surprisingly easily due to poor decisions.
And while investing wisely is crucial, the article suggests the framework for that is actually clearer than you might think, balancing risk and return, maybe using something like the Merton share concept.
But the real challenge, the much trickier part, is the spending. You absolutely cannot rely on those simple, fixed withdrawal rules based on the initial amount. That's a recipe for disaster.
Instead, the optimal approach involves spending a much lower percentage based on the portfolio's current value each year. Your spending has to be flexible, flexing up and down with the market's performance.
And the single biggest insight, perhaps, is that to make wealth last forever, and especially make it grow into a true dynasty, you have to consistently spend dramatically less, maybe only half or slightly more than what you expect your investments to return each year.
It seems navigating this complex landscape, balancing all these factors, is clearly where getting expert-tailored financial advice could really earn its keep.
It's a profound challenge, managing not just the money, but the psychology and the long-term vision.
It really is. This deep dive into the economist's analysis shows us that receiving a large inheritance might feel like gaining ultimate freedom, but actually making it last seems to be about exercising incredible discipline and really strategic thinking. The real balancing act, it seems, lies in weighing that very human desire for immediate enjoyment, that utility of spending today, against the much less tangible, long-term goal of creating a lasting legacy, providing security for generations you might never even meet. How do you possibly measure the value of that distant future potential against the definite pleasure you could experience right now? Definitely something to ponder if you ever find yourself contemplating an enormous inheritance.